Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, May 10th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are the bull markets in gold and commodities persist, fresh evidence of our sticky inflation theme, plus disconfirming evidence of our resilient U.S. economy theme. So the nuance there is gold continues to recover from its recent pullback, up another 1% today to plus 3% week to date. Gold has rallied 18% over the trailing 3 months, defying both U.S. dollar strength and rising real yields. For example, the dollar's up a percent over that time horizon, and the 10-year TIPS yield is up 22 basis points over the last 3 months. Elsewhere, commodities continue to recover from the oversold probable range signals we published last week, particularly energy. For example, the Bloomberg Energy Index is up 2% week to date. Lastly, the preliminary May University of Michigan Consumer Sentiment Report disconfirmed last week's Goldilocks jobs report from an inflation signaling standpoint. In terms of market implications, this morning's data follows other leading indicators, for example, the ISM Manufacturing and Services Prices PMIs, in signaling sticky inflation. Also disturbing within the University of Michigan Consumer Sentiment Report was the one-year expected change in employment, which declined to the lowest level since August of 2011 at the slowest month-over-month pace since August of 2021. This data point joins last week's soft JOLTS report and stagflationary ISM Services PMI report in suggesting the labor market is beginning to unravel. Investors must now be on high alert for a significant loosening of labor market slack in the coming months. So transitioning to our 42 macro dashboard, as always here, we're wrapping up with a question from our global Team 42 investor community. So this one's about two scenarios. So I'll just read the first scenario. So it says, if inflation continues to rise and unemployment rises while non-farm payrolls jolts and ADP decline, we may face stagflation. That's correct. What would the Feds be in response to this situation? Would they prioritize combating inflation or stimulating employment by cutting interest rates? How might the market react? In our opinion, we think the Fed, we know based on everything we've heard from Jay Powell last week, that the Fed has a very asymmetric reaction function. It stands ready and willing to cut rates and ease monetary policy further vis-a-vis its balance sheet and forward guidance if the labor market was to deteriorate meaningfully. However, that risk is not two-sided from a policy rate and balance sheet perspective because they are unlikely, as Jay Powell reiterated several times last week, to respond to incrementally adverse data on the inflation front. All that's going to do is just potentially delay easing. But clearly, in our opinion, we think if all these things happen together, i.e. sticky inflation and an unraveling of the labor market, we think they very much will support the economy and sort of support their and chase their maximum employment mandate and prioritize that over their price stability mandate. Number two, if both inflation and economic growth are declining and the central bank is reducing interest rates, but there are signs of an impending recession, how would markets respond? They'd be collapsing. Would it be seen positively due to the Fed's loosening policy or negatively out of concern for recession? So, we've done a lot of statistical analysis on this. And when you're in a bear market and the Fed starts to ease policy, it's usually at or near the lows of the market. It's right around about a month, give or take, the lows of the various bear markets we've experienced in the U.S. economy over the last 100 years. When you're heading into a potential bear market and the Fed starts to ease policy out of concern for the economy, it's usually a sell signal. Almost always is a sell signal because the Fed, certainly on the duration with which monetary policy lags influence economic activity, is likely to be very unsuccessful in terms of promoting positive economic outcomes, but also in the context of, cleansing the positioning cycle. Don't forget, we're coming from a very elevated place in terms of asset valuations and a very low place in terms of credit spreads. And we're coming from a very asymmetric place in terms of the various positioning cycle indicators that we feature in our positioning model. So we'll, kind of leave it at there. Obviously, if you're a 42 macro client, you're well aware of what those cycle indicators are, what they're currently signaling, and how you should be positioned in your portfolio as a function of those signals and our other risk management signals. So we'll wrap it up there. Darius Dale presenting our macro minute for Friday, May 10th, 2024. Everyone have a wonderful weekend. Best of luck out there. We'll catch you back here next week. Cheers.